let us give some notes first, then we do the question. And I'm going to combine the notes. I'm going to combine replacement maybe with some other part. Sawa, because we need also some other part. So sawa.
Okay.
So let us give notes. So I'm going to stop sharing, then I will share later. Okay. So I think I should start with some notes, and I'm going to use the notes that I shared with you. You don't have to worry about notes already. You have them. Just some reminder as we move on. So advance FM. And then it is replacement analysis. So replacement analysis. I hope it is visible. Silvio.
Yes.
So when we talk about replacement, we need to consider two items. Number one, when we replace a machine, an old machine, with a new machine, or where we only buy a new machine, so we do not have the original machine. We are not replacing anything. It is either we are buying a new machine from scratch, or we are replacing an old machine with a new machine. So let us give some definitions or items which are important. So we can say replacement analysis. Replacement analysis. So replacement analysis is the process by which uh, by which an old and inefficient so old and inefficient asset is replaced with a new asset or machine. So in a situation where we replace an old machine, so we replace an old machine which is inefficient. So we only replace something that is inefficient, meaning it is not working, it is not doing its work. So the process which involves replacing an old machine by a new machine is what we call the replacement. So the new machine, a new asset which is more efficient. Remember, it must be which is more efficient. Which is more efficient. So you replace an old machine which is less efficient with a new machine which is more efficient. Now, the following cash flows must be determined. So the following cash flows must be determined. Must be determined. Number one, total initial outlay. Total initial outlay. Number two, or number B, terminal cash flows. Number C, net operating cash flows. Net operating cash flows. Net operating cash flow. Those three items, you must know how to determine them. So the operating cash flow, net operating cash flow, terminal cash flow, and the net operating cash flows. Now, the first one, let's start with the first one, terminal cash flow. Terminal cash flows. Terminal cash flows. Now, I will give you two items for determining terminal cash flow. One, where we are doing replacement, and number two, in the case where we are not doing replacement. So you need to know both, how to determine both. In the case we are replacing a new machine, or in the case where we are just buying a new machine. So let us start in the case where we are replacing. Let us start in the case where we are replacing. Let us start in the case where we are replacing. Let me look for that. Just a moment. Copy. Yes, thank you for. Let us start with the replacement. So, how to determine initial outlay? Number one, total initial outlay. And you know what is total initial outlay? The total initial outlay is the cost of investment. This one is the cost of investment at time zero. Time zero. So the amount of money that we incur to do a project at time zero is what we call the total initial outlay. So how do we determine it? So this is the format. So format. So we start with the purchase cost. We start with the purchase cost. The purchase cost, we need to add incremental. So we add incremental, incidental cost. So we add incremental initial cost. Then we shall get what we call the effective cost. We get what we call effective cost. Then we add working capital. It can be net. If you have net working capital, net working capital or working capital. So we add working capital. Then we add overhead cost if there is overhead cost. We add them. Then we add or we less. This one depends. So gain or loss on tax recapture. So it can either be a gain or a loss. So you either add gain or you less a loss in tax recapture. Then we less market value of old machine. So the machine that we are selling, if we are doing replacement, we need to less the market value. Then we shall get our total initial outlay. It's also called total initial cost. So it's also called total initial cost. So you can use the word total initial cost. Now this format is applicable for replacement. So this one is only applicable when you're talking about replacement analysis. So this one is applicable when we're talking about replacement analysis. Now, what if the format is about? It's about buying a new machine. Buying a new machine. So we shall start with the purchase cost. We shall start with the purchase cost. Then you're going to add the incidental cost, but not include the word incremental. So the word incremental is only applicable. The word incremental is applicable under replacement. So this one you just add incidental. Cost. Then you shall get what we call the effective cost. Then we add working capital. Then we add overhead overall cost. Now the rest, these two items will not be there. Gain and loss on tax recapture is only applicable in the case where we are replacing. So this one will not be there because we are not replacing. Then overhaul, or then the market value for the machine. So because we are buying a new machine without replacing, the market value for the machine will not be there. So our total initial will be up to this point. Total initial outlay. So have you captured the difference? Have you captured the difference?
Yes, the difference is that buying a new machine doesn't have lessing the market value of the old machine. No,
Yes.
ma'am.
So we won't have the tax recapture. Because now depreciation NV depreciation is calculated from effective cost. And remember, this is a depreciation for new machine. Remember that is depreciation for new machine. So for new machine, for the new machine, depreciation is calculated from the effective cost. So this cost is the cost which is used to determine the effective cost. Sorry, effective cost is used to determine depreciation. The effective cost is used to determine depreciation. Also, before we continue, remember we have gain or loss on tax recapture. Now, gain or loss on tax recapture from the intermediate level, this is a tax effect which arises because of disposal of an old machine. So when you talk about gain or loss on tax recapture, gain or loss on tax recapture, gain or loss on tax recapture, this is the tax effect. It refers to tax effect. Tax effect that arises because of disposal of old machine. So the tax effect that arises because of selling an old machine is what we mean by gain or loss on tax recapture. Now you need to know how to compute it. So how do you compute the gain or loss? So you also need to know how to compute that one. Just a moment. Just a moment. So tuko sawa? We move on.
Yes.
So I was explaining how to compute tax or loss. Gain or loss on tax recapture. This is the formula. So formula for that one gain or loss on tax recapture. Now the formula is gain. You can either have gain or loss on disposal of the asset. You multiply the tax rate. So you multiply with the tax rate. So how do you get the gain or loss on disposal? So gain or loss on disposal of asset is equals to cost minus, I think cost minus accumulated depreciation. Supposed to be, sorry, not cost. Supposed to be sales proceeds minus net book value. Sales proceed minus net book value. And then net book value, remember the formula for net book value? Net book value cost minus accumulated depreciation. So cost, so net book value is equals to cost minus accumulated depreciation. Now, with that one, I think we are done with that. We can go to how to determine terminal cash flow number 2. So number one is fine. So total issue outlay, you can use either the replacement, depending on the question, or when you are just buying a new machine. Number 2 is about terminal cash flow. I think we can move to that one, terminal cash flow. So terminal Now terminal, it is the value of that asset at the end. So when we dispose that asset at the end, we call it the terminal cash flow. Terminal cash flow. So what is terminal cash flow? So terminal cash flow, it is the value of that asset at the end, or the cash flow that you expect to generate at the end of the useful life of that asset. So you can say cash flow expected cash flow is expected to be generated at the end of economic life of the asset, of the machine, of the asset or the machine. So the cash flow that we expect. So the cash flow that we expect at the end of the useful life of that asset is what we call the terminal cash flow. So at the end, so make sure you underline the word at the end of the economic life. So what we expect at the end of the economic life, so the benefit that we expect to gain when we have used the asset and we are ready to dispose it, then that will be called the terminal cash flow. This is the format. So the format is the same for both. The format is the same. Format is the same for both replacement and replacement. So format. So we start with the working capital. Start with the working capital. Start with the working capital. Then we add salvage value. Salvage value. So we add salvage value of new machine for the new asset. Then we less salvage value of old asset. Now, in the case where we do not have an old asset, in the case where we do not have an old asset, this value will be 0. So this one is 0 for in the case we have an old machine or old asset. So this value will be 0. But if it is the normal, then we'll do this is the format. We get the incremental terminal cash flow. Now I have said use the word incremental where we have the replacement. So use the word incremental. Use the word incremental when we have replacement or when we are replacing. Now let's talk about net operating cash flow. Number 3, it is net operating cash flow. Net operating cash flows. Now this is the daily revenue that we expect from the machine. So this is our, we can talk about it as, it refers to benefits, to daily benefits expected from the use of machine from year 0 to the end of life of that asset. To the end of life of that asset. Now the word daily benefit can mean on a yearly basis. So daily benefits means monthly, quarterly, yearly, etc. So it says yes. So the word daily does not mean every day, but it can mean day-to-day operation. So on a daily basis, weekly basis, monthly, quarterly, or yearly. So that benefit that we expect from the use of that machine, so we call the net operating cash flow. And how do you use it? How do you compute this net operating? We have 2 methods. So we can use 2 methods. So we can use number 1, depreciation method, or we can use tax shield depreciation method. So either we use those 2 methods. So the depreciation method or the tax shield method. I prefer the first one, depreciation method. So I would prefer the first method. So I would prefer the first method. That is what I will show you. Let us start with the depreciation method. I will go with just that one alone. You cannot be asking an exam to use no one will tell you to use a method. So it is you to decide which method you want to use. But if you want to know those methods, I think you can decide to check on your notes from the intermediate level. Now, I'm interested with depreciation method. That is what we shall be using. Depreciation method. Now this one, in case we have sales. So in case of sales. So this is the method applicable when we have sales. So we start with the sales or the total sales. Let's call it total sales. Then we are supposed to less variable cost. We shall get total contribution. Total contribution. Total contribution. Total contribution. And then we less fixed cost. Less fixed cost. This is supposed to less so that we can get earnings. So if it's about replacement, use incremental. If it's about replacement, incremental. So this one I'm assuming is replacement. Incremental earnings before depreciation, interest. Let us not include interest and tax. Then we less depreciation. We less depreciation. And remember, it is incremental. If it is replacement, incremental depreciation. Then we get incremental earnings before tax. Then you're supposed to less tax. We get incremental earning after tax. After tax. Then you add back. We add back incremental depreciation. Incremental depreciation. So that you can get our net. So that if it is replacement, incremental net operating cash flows. That is NOCF. That is net operating cash flows. Now this one is in the case where we have sales. Now that's the situation where we have sales. But in a situation now, in other situation, you won't be given sales. So in other situation, you won't be given sales. So how you do gonna determine it? So in other situation, you will not be provided with the sales. You shall be provided with the savings. Now, in the case of being provided with the savings and not sales, how are you gonna do it? You start with the savings. And then these savings, depending on the question, will be the same as contribution. So savings also means contribution. So kwa sababu ukiwa umepatiwa contribution, then ujue inamaanisha, so utaanzia hapa. You start from this point. So this one is the case where you have been given savings. So you start from that point. Tuko sawa?
Yeah.
Now, I will only focus with this method. The other method, maybe nitakutumia notes uangalie venye inakaa. But for now, we shall go with that. Now, let's go to our past paper. Now, can you read question number 1B?
Okay. Question 1B. As the finance manager of Popo Limited, the board has approached you to evaluate the proposed acquisition of new machinery. The purchase price of the machinery is 100 million shillings. It will cost another 20 million shillings to modify it for special use. The machine will be sold after 5 years for 40 million shillings. It will require an increase in net operating working capital of 8 million shillings. The additional information: the purchase of the new machine will not have any effect on revenue, but it is expected to save the company 45 million shillings per year before tax operating costs, mainly labor. The corporate tax is 30%. The company uses the straight line method of depreciation. The project cost of capital is 12%. Required, using the net present value method, evaluate whether the machinery should be purchased.
Number B. Okay, number B we shall do it later. Sivyo.
Yeah.
So let us see the question. Let us start by preparing the total issue of the Sivyo.
Yeah.
So we start with the purchase. So we start with the initial, total initial outlay. So we start with the total initial outlay, TIO. Silvio?
Yes.
So how much is our total initial purchase cost from the question? The purchase price for the machinery was 100 million, Silvio.
Mhm.
Mayona.
You think it is the April 25 question?
1B. Mana 100.
Just a moment. Yes, yes, I've seen it.
And then it will cost another 20 million to modify. So that modification is what we call the incidental cost. Silvio.
Oh, incremental cost.
Incidental cost. So incidental cost is part of, so modification is part of incidental cost. 20 million. Silvio.
Yeah.
So when it will cost another 20 million to modify. So when you talk about incidental cost are costs which are incurred before the use of machine. Kwa sawa?
Oh, okay.
Kwa machine ifike kwa factory ianze kufanya kazi. So maanisha wata modify kwanza the machine before ianze kazi. Kwa sawa?
Yes.
So there's no any other cost hapo. So we get the effective.
We get the effective cost
Of 120 sivyo. Then you add working capital. Kama tupatie hapo. Working capital ya ngapi?
Working capital of 8 million.
Yes, of 8 million. And then inaishia hapo. We do not have the other thing because it's not about replacement. So our total initial outlay itakuwa ngapi?
128.
But kama ingekuwa mambo na replacement, we could have done something to do with the gain or loss on tax
The
recapture.
gain or loss on tax.
Then we also left with the market share, sivyo? The market value of the machine. Number 2, we are going to determine terminal cash flow. So our typing of cash flow, we start with the working capital, which is we have it here. How much? Page Silvio.
Cash. Yes, working capital we have 8 million.
Then we add salvage value of the machine. Now hii itakuwa tu hii peke yake because we are not replacing, so we do not need to do the salvage value of the old machine, sivyo? Itakuwa tu the salvage value of the new machine. So terminal cash flow itakuwa ngapi? Let us see tumesema terminal cash flow, sorry, the salvage value is the value of the machine at the end of the useful life, sivyo? So the machine can be sold at how much?
40 million.
So that is the salvage value of that machine. 40. We shall have 40.
40 million.
Okay. Remember, so is at the end of the year. You need to be very keen of year 5, sivyo?
Yes.
So you underline that one, and then so is at year 0 today, sivyo? Then you also need net operating cash flow. Net operating cash. We are starting with we had savings, sivyo?
Let me
The company will
check.
save amount. Now that savings is the revenue to the organization in form of, so the revenue in form of savings. Information number 1. The purchase of new machine will have no effect on the revenue, but is expected to save the company 45 million per year.
Per year.
So this one is the savings before cost, before tax. Before tax. And that
45 million.
Now, unajiuliza, do we have fixed cost? Hakuna. So kumaanisha this one is the savings before tax. So we are supposed to less the tax because hakuna fixed cost. What about depreciation?
Tumepewa straight line method.
Now we need to complete depreciation, sivyo?
Yes.
So we complete here depreciation. Now depreciation is equal to effective cost minus salvage value over number of economic life, number of years of economic life. Sivyo?
Yes.
So effective cost is 120. Our salvage value was Mayo
40.
And then it was for how many years?
5 years.
What would be that? What would be the depreciation? So 120.
It's 16.
Yes, 16. So we less depreciation. Of 16. Then we shall get savings after savings before tax also. So 45 minus 16, 29. We less tax. That's how many percent?
30%.
Of 29. So 0.3 times 29. 8 point. Then we get savings after tax. So 29 minus answer 20.3. Then we add back depreciation of 16. Therefore, that's 6 zero. We get the net operating cash flow. So let's go to the question. Walikuwa nauliza nini? Go back to our question. Walikuwa nauliza using NPV, we need to evaluate whether the machine should be purchased. Hello. Hello.
Hello. Yes.
Ilipotea bana, network ilipotea.
Niliacha kama tujaenda hapa kwa NPV.
Tuko kwa NPV. Hapo tunarudi tu hapo hapo. Hiyo ndio no issue na online. Network ikipotea kidogo. Now, but I hope now you can see the board.
Yes.
So we are saying for you to calculate NPV, you take the present value cash inflows minus the present value cash outflows. Sivyo?
Yeah.
Now in this case, we have two cash flows. Number one, we have the terminal cash flow because this is the benefit at the end of the year 5. Sivyo?
Yes.
And then this, which is every year from year 1 to year
year 5.
Year 5. But remember, the cash flow is the same from year 1 to year 5 because this one is from year 1 to year. So meaning mwaka wa kwanza ni 36.3, mwaka wa pili 36.3. So kila mwaka tuna expect we shall be having the same cash flow of that 6.3 million. Sivyo?
Yes.
So meaning our NPV will be able to, let's start with the present value cash inflow. Let's start with this one. That is 6.3. You multiply with the present value cash inflow. Remember it's annuity, then year 5. Sivyo?
Yes.
Rate, what's the rate?
12%.
So the rate is 12%. Plus, you also have another benefit, which is the terminal cash flow. Sivyo?
Yeah.
Which is 48 times the present value. So the present value interest factor is supposed to be present value interest factor. Now, this one will be N because it only appear.
Oh, yes.
So it is N. But it only appear at the end of year 5. Rate is
12%.
Minus our cost. Our initial cost at year 0, which is 120.
128.
Let's go to our table. That is 6.3. Now, annuity year 5, that is the table for annuity. So 12%.
Itakuwa 3.6048.
3.6048 plus 48 times. Now this one, but the upper table, the one for end period, 0.56.
0.5674.
That's 120. So utapata NPV. What is the value of NPV? It will be equal to 36.3 times 3.6048. This is 130.8542 plus 48 times 0.5674, which is 27.2352 minus 128. So our NPV equal to what? 130.8542 minus our plus answer minus 128. So mimi napata 30.0894, which is positive. That is 30 million. That is positive figure, sivyo? So should we accept or reject the modification of the new machine?
We accept.
So accept the modification of new machine. So we accept the modification of the new machine. Now let me share the question, part B of that question, which is important. Let me share with you. Itakuwa wapi? Can you read part B?
Okay. Assume the board suggests that you conduct a scenario analysis for this project because of the uncertainties of cost savings, salvage value, and net operating working capital. After an extensive analysis, you come up with the following probabilities and the values for the scenario analysis. So we are given the scenario probability, before tax savings, salvage value, and the net operating working capital. Required, the project's expected net present values.
Yes. Now, this is a topic which is called scenario analysis. So you need to talk about the scenario analysis. Now, before we do that question, I want us to have some notes on scenario analysis. So open, do you have that PDF? You open the PDF that you deploy in a JITA, risk analysis.
Risk analysis.
Nilikuwa nimekutumia kwa group. Do you remember?
Yes, nimeipata.
Nimepata. I think that will be good. Now, this one haina mambo mingi. We shall just give a definition for it and then we do a question. Itakuwa sawa?
Yes.
Now, from the first step, you can see the risk analysis in capital budgeting. Can you see it? We have definition of risk and the type of risk. Those one we are not going to talk about them because you know them. Sivyo?
Yeah.
I'm interested in the methods. Can you see the methods of evaluating risk?
Yes.
How many methods do we have there?
We have 9.
9. So I'm interested with the number 8. You see sensitivity analysis? Sensitivity analysis. Number 8.
Yes. Yes.
So what you do below this question and take a method of evaluating risk. So methods of evaluating risk, then you list them.
Yeah.
Once you list them, let us start with method number. We shall do method number 2 and method number 8 for now, for today. So sawa.
Okay.
So method number 2 and method number 8. Method number 2. Okay, number 2 and number 3 they are related, so we can combine 2 and 3, then 8. So sawa. Then we call it today. Call it a day, then tomorrow tumalizie hizo zingine. Sijui kama tutaweza ama tukae sana kwa class.
It is okay.
Okay, wacha tufanye kwanza tuone the situation. So methods of evaluating risk. So methods of evaluating risk. As I have said, I will start with the second and the third method. Then we do the sensitivity if time allows. So expected monetary value, this one you did it in QA, but we are just going to talk about it just some introduction. I'm not going to talk about it so much because you already know what is it in your previous level. Now, It is the average of the monetary value. We can say this represents the average value. So the first average value of the monetary values. So it is the average. So it is the average value, and we can compute the expected monetary value as the summation of what? EMV times probability. Or so it's supposed to be monetary value. Summation of the monetary value times probability. The monetary value, this monetary value, we're going to get the cash flow. Those are our cash flows, but in form of monetary value. Now, you can another method is you take the cash flows or the monetary value, you divide by n, divide by the number of periods. And then you can say the higher the EMV, the better the project. The higher the EMV, the better the project. The higher the EMV, the better the project. Now, this EMV formula can also be used to calculate expected net present value. How do you compute expected net present value? Using this method, so expected net present value is equals to the summation of the NPV times probability. So the expected net present value is the same as saying expected monetary value because it's the benefit. So they can use the word monetary value, or they can use the word present value, expected net present value. So whichever item they decide to use, that is the formula. That is the formula. Number two, yes, Kosawa.
Yes.
Yeah. Number two, can talk about standard deviation. The standard deviation refers to the measure of risk. This one refers the measure of risk. And this is how you get to the standard deviation. Standard deviation is equal to what? Square root of the summation of monetary value minus expected monetary value squared and probability. Or if you're using NPV, the summation of NPV minus expected NPV squared times probability. Times probability. That will go sour. Now, we can also calculate this manner. Expected NPV minus NPV minus expected NPV squared over n minus 1. So that is where we do not have probability. That is the case where we do not have probability. Now, let us move on to let's go up to sensitivity analysis. Sensitivity analysis. That is number 7. And then Under sensitivity analysis, we shall talk about two items: sensitivity analysis and scenario analysis. So we shall talk about sensitivity analysis and scenario analysis. Let's go to number 3. Number 3. So sensitivity analysis and scenario analysis. Hii black pen inachafua sana. Hii black pen nafaa kutumia sana. So sensitivity analysis and scenario analysis was number 3. Sensitivity and scenario analysis. So we can say that let us define what sensitivity analysis. First, sensitivity analysis. Sensitivity analysis refers to technique which identifies the key variables, which identifies key variables. So techniques which identify key variables which affects profitability, i.e. NPV. So when we talk about sensitivity analysis, this analysis which identify the key factors which affects the profitability. In our case, profitability is NPV. So just remember that profitability is our NPV. Now, what you need to know is this. What you need to know is, just a moment. Okay. Now, before we continue, we need to know under this analysis, variables are independent of each other. So when we say variables are independent of each other, it means we need to evaluate each variable separately. So under sensitivity analysis, another definition we can use, because this is a technique which identifies the factors which affects profitability independently. So you can say another definition refers to technique which identifies which factors affects profitability. Remember, I said profitability here is NPV. One at a time. So we cannot check all the factors at the same time. So we can only do it one at a time. For example, if this is our how to get NPV, for example, NPV is equals to S minus V minus fixed cost. Okay, let me write 12. sales minus variable cost minus fixed cost higher times present value interest factor, maybe annuity, minus total initial outlay. So that's our method for calculating NPV. Now for sensitivity analysis, so when we talk about sensitivity analysis, we analyze each factor separately. For example, we analyze sales first. So we analyze sales first and then we check how does it affect our profit separate. Once we do with the sales, we do variable cost separate. So that is for sensitivity analysis. So each factor or each variable, and remember it's our variable. So sales as a variable, variable cost as a variable, fixed cost as a variable, total cost as a variable. So each variable is identified, then it is measured separately to check how it affects the profits. So the first technique which identifies which factors affect profitability one at a time. So we have two types of sensitivity analysis. So two types. So we have two types of sensitivity analysis. Number one, so divided into two. Number A, break-even analysis. And number two, impact analysis. That's how the break-even analysis. Break-even analysis. So break-even BEA, that is break-even analysis. Now, so in this method, key factors affecting the profitability are identified. So in this method, key factors affecting profitability are identified. So that's the first thing. So the key factors are identified. Then, as I said from the definition, then evaluated, each at a time. Each at a time. Each at a time. Holding other constant. Holding other variables constant. So that was what you need to know. When we are talking about break-even analysis, and remember that is break-even analysis, that's under sensitivity. Each factors, we identify the factors, for example, sales, variable cost, or fixed cost. Then we analyze each factors at a time. So if it says we analyze sales, we ignore the rest. Once we complete analyzing one factor and go to the next factor, then we ignore the other factors. Now, percentage change. So you need to know how to, once you get the percentage change, this is how you, so this is used to get the percentage change before and after. So before and after. So P1 minus PO over PO, we shall do a question, don't worry. And then remember NB at BEA, at BEP, that is break-even point. NPV is 0, which means that the present value cash inflow is the most present value cash. So at the break-even point, at the point of break-even, NPV is always 0. So you need to remember that NPV is always 0 and that the present value cash inflow is the same as present value cash outflow. And then you also need to know the smaller the smaller the percentage change. The smaller the percentage change, the more the sensitive the variable, the more the sensitive the variable. So the more, sorry, the smaller the percentage change, the more the sensitive the variable is, and vice versa. So that one and vice versa. We shall do a question for breakpoint analysis. So for now, I'm not going to do a question. I'm interested in the scenario analysis. Let's talk about impact analysis. Number 2, impact analysis. Impact analysis. Also, I'm not going to do a question for impact analysis, but I'm interested in the scenario. I do a question tomorrow, or maybe if we have time. Now, so under this technique, we compute percentage in NPV when variables are affected. So we can say you can say this. So under this technique, under this technique, we compute percentage change, we compute percentage change in NPV. In NPV, when the factors or variables are affected adversely. So in this case, when we talk about impact analysis, we only check for the variables which affects our profit adversely. So adversely means when the variable is poorly performed. So under this technique, we compute the percentage change that affect the NPV only when our variables are affected adversely, when they are affected adversely. Now, the higher the change for impact, the higher the change, the higher the percentage change, sorry. So the higher the percentage change, the more the sensitive the variable, the more the sensitive the variable is. Now, we are going to wrap that one so that we can talk about scenario analysis. But remember, we need to do a question for breakpoint analysis and impact analysis. But because we were doing the question for April, let us now introduce scenario analysis. Scenario analysis. Now, scenario analysis considers the scenarios. So we can have three types of scenarios. Which? You can have good, worse, and maybe average. Or the sector can have, we also talk about scenario, say that the sector can have boom, recession, and maybe peak as our scenarios. Liquidity. And remember, they are always attached to probabilities. So when you talk about scenario analysis, you're talking about a base. So we have the base. The base is what is affecting us now. Then from the base, we can have either worse or good. We can have either worse or good. So that is what it means we talk about scenarios. We can have different scenarios in an economy. We can have different scenarios in an economy. You can have scenario 1, scenario 2, or scenario 3. We can have good, worse, or average, or you can have boom, recession, or peak. Let us say something on scenario analysis. Scenario analysis. So scenario analysis. Scenario analysis. So we can say, you can say this. Let us say that this is the use. This is the use of horizon analysis. Yes.
Yes.
Unasemaje?
Not really. Some background noise.
Okay. So this is the use of horizon analysis to project profitability. Remember, in our case, profitability is NPV. Kwa sawa? Then we say this is more relevant than sensitivity analysis. Then you can say under this method, each variable are analyzed at the same time. At the same time, to check its effect on profitability. And remember, our profitability is our NPV. So remember for sensitivity analysis, remember for definitely for sensitivity analysis. For sensitivity analysis, the factors were analyzed separately, each at a time. Now for scenario analysis, we need to consider all the factors or all the variables at the same time. Because our
Yes.
yeah. Now let us do this question of ours. Let's go back to our question. Let me share the question. So can you see the question? So which scenario do we have? We have three scenarios. Which one and which one?
We have worst case, base case, and the best case.
Yes. Now for the best case, we have our NPV. How much? Because we calculate about June.
For the
Okay, let us go to the base case. What is our earnings before tax? Before tax savings?
45.
45. Salvage value?
40.
Net operating cash, working capital?
8 million.
we use those information to calculate NPV, sivyo? Umepata
Yes.
NPV? What is the NPV?
We got our NPV of 30.0894. It's not the one we got in the first question.
We repata the last item, the last NPV ya mwisho tumecalculate hapo juu.
Ilikuwa 30.0894.
Now, what is the probability for this case?
0.40.
Now we need to calculate also the NPV for the other items. Let us start with the worst. NPV for worst.
Maybe you can stop sharing the questions.
So umeweka hizo items unazijua ni gani gani.
Niko na hiyo question hapa nimefungua.
So let's calculate NPV. Now before we calculate NPV, we need to know the total cost. Total cost itakuwa ngapi? Total ni show hapa nifanya tu kuifanya ungefanya kwa exam. So what is the cost for worst NPV for worst?
Worst case
Price. Itakuwa the same. Whether itakuwa ile 128 huko juu, sio kweli? Whether tuko kwa worst or bad condition or whichever condition, the cost itakuwa remain 128. Sio kweli?
Oh, okay. I couldn't have known that. So it will remain the same for all the
Cost.
cases.
Now let us now see the savings. We have terminal cash flow, sivyo?
Yes. Even the terminal cash will remain the same.
Now it depends with the question. Tumepatiwa kwa swali. Tumepatiwa capital.
Yes, tumepewa net operating working capital.
Ngapi?
For us it is 6.4 million.
6.4. Then we are supposed to add the salvage value of that machine. The salvage value itakuwa the same kwa sababu tujapatiwa ingine. Huko juu.
Tumepatiwa salvage value.
Hapo. Ya ngapi?
32 million.
So kwa hiyo itakuwa ngapi total? So 32 plus 6.4. That is 13 point. Watukumbuke ni ya what? Ya 500. Tuko sawa?
Yes.
What else? We also need net operating cash procedure.
Yes.
So what is our savings?
Our savings are 54.
54.
This is still for the worst case.
Tuko kwa worst bado.
For worst case savings ni 36.
That is for exam.
Before tax savings.
Before tax, then we need to net depreciation. So nakumbuka, you remember the formula?
Yeah, yes.
Ama tunaweza tu uchora. Unaanza na savings. Unataka savings ni ngapi? 30?
Savings
54.
Not really 36.
Or 36 savings. Yeah. Then you are supposed to less depreciation, sivyo?
Yes.
Yeah. Now depreciation tunasema ni depreciation tunasema ni tunachukua cost. Cost ni ngapi?
Cost we less salvage value. Our initial cost ni 128.
Cost ni 128. Hii haitachange, sivyo? What will change is the salvage value, sivyo? 6. 6. What about the school life?
Hapana, the salvage value ni 32 million. 6.4 ni net operating working capital.
What is the useful life?
Mm,
The useful life will remain the same.
5 years.
Yes, that will remain the same as 5. So divided by 5. Itakuwa 128 minus 32 divided by 5. Itakuwa 19.2. Eh?
Yes.
So tutakuwa 7 before tax. Then we less tax. Which is 30% of that amount. 5 point. Tupate savings after tax. Mm-hmm. 11. Then we add back deviation 19.2. Tutapata net operating cash flow. So plus 19.2. About 30.96. Yes.
Yes.
30.9. Let us calculate NPV. Itakuwa ni 30.96 times. What was the rate?
The rate was 12. Ilikuwa 12%.
So itakuwa 3.6.
So hii tunaangalia annuity.
Ya kwanza ni annuity, this one kwa sababu ni from year 1 to 5. Hii unaangalia the end because ni ya pass moja. That 8.4 unaangalia for year 5 only. But unaangalia ya juu the upper part.
Hii ilikuwa 0.5674.
0.5?
5674.
Yes. Then to minus cost. What's our cost? 120.
128.
We shall get the NPV for that. The worst scenario. Unapata 5.33 39 28. Are you getting that? Yes.
Yes.
And let's go to the next one. So tumefanya base first. Next ni
Next one is best.
best. And let's start with the short way. Sasa itakuwa same, sivyo? Haitakuwa same kwa sababu unafanya makosa. Ndio kwa hiyo itakuwa same. How do you get a total short way? Tunachukuanga purchase price, sivyo?
Kuto purchase cost tunaongeza incremental cost.
Gari zile cost alafu na tena
Working capital. Yes.
So see you back tofauti na ya base. Maisha itakuwa 120. Ndio kweli. Hebu turudie hii. Hii 128 kama hii. Purchase cost ilikuwa how much? Purchase cost ilikuwa 100, sivyo?
Ilikuwa 100.
Plus what was the modification cost? 20. What about working capital? Working capital ya was?
Working capital, the net 6.4. 6.4.
At 126.4. Ndio.
Yes.
Inakuwa 6.9928. Uko sawa?
Mm.
So hapa itakuwa ni 100 plus 20 plus what is the working capital for the best?
For the best, the net operating working capital is 9.6.
Both tuendelee. This one iko sawa, depreciation effective cost. Ndio. Pia ina shida.
No, basi si pia hapa inamaanisha pia 128 haitakuwa the cost of that item.
Hebu turudi pale juu tukikalculate hii net base. Depreciation tutumia which figure? 120 ama 128?
Tulitumia 128.
128.
Yes.
Tunafaa kutumia effective cost. Hebu enda kwa ile ya juu kabisa ukifanya unaambia effective cost ilikuwa ngapi?
Effective cost ilikuwa 120.
120. So na depreciation hapo juu you see?
No, nimeona hiyo ya kwanza depreciation tulitumia 120.
So hata hapa inafaa kuwa 120.
So the hapa ku calculate depreciation, the first effective cost won't change.
So hiyo haichange. So hapo haichange. So itakuwa 120 minus 32. Hivyo divided by 5. 17 point. That would be 17.6. Kwa sawa? So that is 6 minus 18.4. 18.4. Hizo ni kama zita change zote. Tunasema 17.6. Tupatie 18.4. 5.5. That means 8. Then you add back to it. Kwa sawa hadi hapo? Tuko sawa hadi hapo? Maana you that one you correct that one. Tuko sawa sasa. Na confirm is figure 30.48. So 5.2 2625. So si umeona vile tumefanya? Si umeona hadi hapo? Tuko sawa? Tuko sawa?
Yes.
Sawa. So let us go to the next NPV for the best. So for the best, what is our working capital?
The working capital is 9.6.
9.6. 9.6 hivyo. 100 plus 20. 400 net point. 26 hivyo.
Yes.
Total cash flow, but you prepare salvage value 9.6 plus. So that is the working capital. What is the salvage value?
The salvage value is 48 million.
8 million. So 48 plus 9.6. 57.6. Then we need the net operating cash flow. So what are our savings for that one?
Savings are 54 million.
So 54. We are supposed to get depreciation. Those are depreciation. We are supposed to take the effective cost. Sivyo.
Yes,
Minus salvage value, which is 14.
48.
So 120 minus 48 divided by 5. 14 points.
Mm.
So savings before tax. 4 minus answer. 9.6. Then you get tax. 30%. It is 11.88. We get savings after that. Then we add depreciation back. Itakuja ngapi?
Mhm.
Depreciation back. So plus 14.4. Shade hapo liko sawa. So NPV itakuwa ni 42.12 times. So the same 3.6 plus our terminal, which is 57.6 times 2 then we minus 1.
Mm.
So hadi hapo.
Yes.
Uh-huh. 57.6 times what? 0.74. 129.6. Tunapata ngapi? 54 91. Tuko sawa hadi hapo?
Mm. Yes.
Now let's back to our question. What was the requirement?
The project expected net present values.
So expected net present value. You're supposed to take the summation of NPV times probability. What is the probability of was 0 point?
0.30.
So hii itakuwa na hii ingine 0.3 pia.
No. Oh, yes.
Yes, kwa sababu inafaa ikuwe hii plus hii plus hii na kuja 1. Zote tatu. Kwa sababu so what would be our expected NPV? So tunasema itakuwa ni 30.04 times 0.4 plus the summation 5.262 5.2625 and 0.4 plus Mgani who is next 54.91 54 and 0.3. That will be our expected NPV. Any question?
No. Yes.
What will be the answer? Four, these are supposed to be 3.
Moja
Supposed
ni
to be 3.
3.
itakuwa 30 point. Is that the answer?
Is it supposed to give the same answer as the net present value for the best case?
For the best case. Inafaa ikuwe
Because
in the average.
unajua imeleta
Inafaa ikaribie. Si lazima ikuwe same kwa sababu the base is the average. Ndio ya katikati. So remember when you talk about expected NPV, you're talking about the average, sivyo?
yes.
So inafaa ikuletee something that is somehow imekaribia the base one or ile ya katikati. But not necessarily the same. Si lazima ikuwe same, but ikiwa same, very good.
But yeah, this one imetupea the same.
Yeah, so that is how you are supposed to do that question. Any question?
No, maybe you can give me a question that is similar. I try and see if I'll work it out.
Similar to that.
Yeah.
So unajua lazima tufanye kila kitu kwanza ndio
Oh, lazima tufanye all the other methods.
kwa sababu vingine unapata wamemix.
Okay.
But you can try for this one of May 2015 because utapata hiyo swali.
Ulinitumia zile maswali za kitambo.
You can try your May 2015. Question number 1 B. But that one is only replacement alone. Uko sawa?
Sawa.
I think amesolve your swali hapo. You can also check. You also have November. November, lakini this one is sensitivity analysis. November 2017 1B. That one is sensitivity. That one you cannot do, but unaweza iangalia tu. So what we do, wacha tufanye kesho kwanza sensitivity analysis. Then tuone itakuwa. Ndio.
Sawa.
So tomorrow tutajaribu tumalize hizo risk analysis hizo zingine tumeziname pale. So that PDF kwa tumebakisha ndio ya replacement part. Kuna some item hapo ndani tunafaa pia kufanye. Juu kama vile tunaweza combine zote mbili. Utaona. But lazima tumalize hiyo others. Tulifanya 2 3 na 8 sivyo?
Yes.
So hizo zingine lazima tumalize kesho. And then tuingie kwa hiyo part 2 hiyo nini? Ya replacement. We introduce some other items kidogo tu hapo. Ndio tumalize this.
Nyamaza.
Now kesho mimi nita focus na 2 items. Because the new thing hujawahi cover maybe. Simulation analysis which also iko kwa nini iko kwa advanced MA simulation analysis na pia decision tree zote ziko kwa advanced MA pia. So tukisoma hapa na tusome huko itakuwa rahisi. So ukisoma kwa huko hivyo kwa nini kwa advanced MA itakuwa rahisi kwako kama umeshasoma hapa. Though I also have a video for that one for advanced MA you shall also check. So but huko kwa advanced MA simulation analysis and inventory. Uko sawa?
Sawa.
And then decision tree iko na topic inaitwa decision theory. So those one tutakava zote. Tutakava both kwa MA na kwa FM. So that ukwe familiarize nazo kwa sababu maswali zinaweza kuja a bit different but setting nini approach is the same. So kesho niko free. So sijui yako kwa vipi saa ngapi utakuwa available ndio
tunaweza anza we can start at 5.
5. So mimi kesho 5 nitasema kesho ikifika masaa nitasema nikae kwa nyumba ndio tuanze mapema. so that tunaweza kuwa hata na 2 class hivyo 5 to 7, 7 to 8. Hiyo tutakuwa tumemaliza topic 1 kesho yote full.
Sawa.
Sasa make sure you write notes on decision 3. Decision 3 na simulation so that tomorrow tuanzie hapo.
Sawa.
Sasa good night.
Okay, good night. Kendi naweza kuongea? Eh? Sikia.